I used to think ETFs were the honest path to wealth. I made my first investment 10 years ago, and today I have more than doubled my money. But only now do I realize I was leaving every third dollar on the table. And it's only now that I've uncovered the real lessons that kept me in blind spots, things they don't teach you in the books. Today, I'm going to share those 5 lessons with you. Enjoy the video. But first, if you like my content, hit that subscribe button. Quick disclaimer, I'm not a financial advisor, and this is not financial advice. Always do your own research before making any investment decisions. Lesson 5. Your diversification might be an illusion. ETFs can hide shadow correlation. And this is one of the most dangerous aspects that almost no one warns you about. You buy an ETF thinking, I own 500 companies, that's super diversification, my risks are spread out. On paper, yes. But in reality, especially during crises, something known as shadow correlation kicks in. When the market drops, like in 2008, 2020, or 2022, 80 to 90% of the stocks inside most ETFs start moving in the same direction, down. Why? Because hedge fund algorithms, institutional traders, and bots start selling entire sectors simultaneously. Growth stock ETFs, tech ETFs, broad market ETFs, they all suddenly behave like a single asset. You think you own different companies, but in reality, they are all connected through the same major holders, index weightings, and shared risk factors: Fed rates, inflation, geopolitics. March 2020, the S&P 500 dropped 34% in a month. But inside a typical S&P 500 ETF, nearly every position fell, from Apple to Walmart. The difference between the best and worst stocks was minimal. Everything sank together. Don't blindly trust diversification by numbers. Check the correlation inside your fund. If 70% plus of the assets are tied to one sector or factor, like tech dominance, it's not diversification, it's disguise. Add real alternatives. Bonds, commodities, gold, cash, things that don't fall together with stocks. And remember, true protection isn't about the number of positions. It's about making sure your assets don't all dance to the same tune when panic starts playing. Lesson 4. Liquidity bubbles. ETFs create liquidity bubbles. And this is one of the most treacherous traps that almost no one warns you about. You buy a popular ETF, watching billions of dollars pour into it every day from retail investors, pension funds, and robo-advisors. The prices inside the fund go up not because the companies have improved, but because the demand for the ETF itself is enormous. This is a classic liquidity bubble. The inflow of money inflates stock values, even if nothing has fundamentally changed. When the hype fades, and it always fades, the reverse process begins. Mass outflows force ETFs to sell assets to cover redemptions. The selling happens in panic. Prices drop sharply and you lose 40 to 60%. Just like in 2022 with tech ETFs, ARKK fell over 70%, QQQ dropped 35% in a single year. You thought you were investing in the future of technology, but in reality, you bought into a crowd that arrived last and left first. This isn't about the market always goes up. It's about ETFs amplifying the herd effect. The more money flows into a fund, the more it inflates, until it eventually bursts. Liquidity seems perfect, but in a moment of panic, it vanishes. Spreads widen, and selling pressure drives prices down. Don't chase the hottest ETFs with massive inflows. Choose funds with moderate AUM and steady flows, not hype. And always keep part of your portfolio in less fashionable assets, bonds, commodities, cash, so you don't depend on the crowd. Because when everyone runs for the same door, then the exit becomes very narrow. Lesson 3. Mindset. The 2 most dangerous lessons about ETFs that almost no one talks about honestly. You can do everything right, but still lose huge money because of one thing: your own behavior. The first lesson is the power of staying invested. The biggest mistake ETF investors make is panic selling during a crisis. You buy an ETF because you believe in the long-term growth of the market. Then 2020 or 2022 arrives. Your portfolio drops 30 to 50%. You open the app, red numbers, the news screams recession, everyone around you is selling, and your brain triggers panic mode. I'm losing everything. I need to save what's left. You sell, you lock in the loss, then 6 to 12 months later, the market recovers, and you're left empty-handed, while those who just sat and waited are already up 50 to 100%. ETFs don't protect you from stupidity. They give you a tool that only works if you don't touch it in moments of fear. History repeats itself for decades. In 2008, most people sold at the bottom, losing 40 to 60%. Those who held on made 2 to 3 times more than they invested. But holding on isn't about willpower. It's about accepting in advance. Downturns are normal. This isn't the end of the world. It's part of the process. The second lesson: check your portfolio rarely. Frequent checking kills more money than any crisis. You check your ETF every day or every week. You see red numbers, your heart races, your brain screams, sell. You start selling not because your strategy is broken, but because your nerves can't take it. Studies show investors who check their portfolio once a quarter or once a year earn 1 to 2% more per year than those who monitor daily. Over 20 years, that's a difference of hundreds of thousands of dollars. Why does this happen? Because the human brain isn't built for volatility. Every red day is stress. Every green day is euphoria. And you make decisions based on emotions, not strategy. Those who check rarely simply don't see these fluctuations and don't react to them. Set a rule. Look at your portfolio no more than once a quarter. Better yet, once a year. Set up automatic purchases and dividend reinvestment and forget about it. If you're scared, remove the app from your phone's home screen. Set a password that only you know, or even delete it for a while. This isn't weakness, it's protection from your most dangerous enemy, yourself in a panic. Try it right now. Decide that for the next 3 months, you won't open your portfolio more than once a month, and write in the comments in a month. Lesson 2, your money is burning away. One of the most underestimated factors when choosing an ETF is turnover, the percentage of assets the fund sells and buys over a year. The lower the turnover, the better for your long-term results. Why does this matter? ETFs with high turnover, 30 to 100% and above, constantly rebalance, selling some stocks, buying others. Each of these transactions creates hidden costs, commissions, spreads, market impact costs. Plus, the fund generates capital gains and you pay taxes every year, even if you didn't sell anything yourself. In the end, these invisible losses eat up 0.5 to 1% of your annual returns. Over 20 to 30 years, this turns into tens of thousands of dollars that you simply never received. Now, funds with low turnover, under 20%. They hold assets for years, rarely changing their composition. This reduces internal costs and tax events. Such ETFs behave more steadily, fewer internal losses from frequent rebalancing. Your portfolio fluctuates less when the market drops because the fund isn't forced to sell assets in a panic. Real example, 2 similar broad market ETFs, one with 5% turnover. Over 20 years, you get 0.7% more in annual net returns. Another with 40% turnover loses that 0.7% to hidden costs and taxes. The difference over 20 years with $500 monthly investments, about $40,000 to $60,000. That's not pocket change, that's your future freedom. Lesson 1, the smart move. One of the most underestimated ways to accelerate capital growth is adding dividend-focused ETFs to your portfolio. These aren't just stable funds, they're a tool that gives you real cash flow every month or quarter. And this cash flow becomes your secret accelerator for compound interest. Regular growth funds rarely pay dividends. All profits are reinvested inside the companies. Dividend-focused ETFs select companies that consistently share part of their profits with shareholders, often yielding 3 to 5% annually in dividends. You receive money in your account regularly, $50 to $200 per month from a $50,000 to $100,000 portfolio. And here's the key, you can immediately reinvest these dividends, buying even more ETF shares. Every reinvested dollar starts working on its own, generating new dividends. This accelerates compound interest by 1.5 to 2 times compared to funds that don't pay dividends. Or if you spend them. For example, you invest $500 monthly in a dividend ETF with an 8% total return, capital growth plus 3 to 4% dividends. After 20 years without reinvesting dividends, around $300,000. With reinvestment, already $450,000 to $500,000. The difference, $150,000 to $200,000. That's not pocket change, that's your future freedom. In 2026, this is especially relevant. Fed rates are falling, bonds and deposits yield less, but companies with strong balance sheets keep paying dividends steadily even in uncertain times. You get a double effect, stable monthly income plus capital growth from rising stock prices inside the fund. If you enjoyed this video, hit that subscribe button. Interesting content is on the way. And always remember, trust only your own research and make decisions without emotions. See you next time.